Okay, well, welcome back, everybody. Could just settle down. Again, for those who've just walked in, my name is Dr. Leon Perlman. I'm the conference organizer and head of the Digital Financial Services Observatory. And after that great session, I think there's a lot of food for thought as far as investing goes. And to do that for us, from a VC perspective, is Associate Professor Eric Cantor, who's going to moderate the next panel. Eric's well known in VC and entrepreneurial circles. He's MD of Mobile Global and teaches Fintech at the university. So over to you, Professor Cantor.
Thank you, Dr. Leon. Good morning, everybody. Thanks for coming out. As you said, my name's Eric Cantor. I've been a web and mobile business builder, product manager, and investor, working on a number of different products. Most recently in Fintech, I built a product called Wage Goal that helps financially underserved workers avoid payday loans and other damaging borrowing. We're here today to talk about the climate and trends in Fintech venture capital. We have an incredible panel to my right of venture capitalists that we want you to hear from. This sector has attracted more than $15 billion globally of investment just in 2016. Obviously, it's on a lot of people's minds. From what I understand, the Fintech classes in business schools are completely oversold before the syllabi have even been created or the textbooks have been written. I definitely sense that in my class over at the International Affairs School. So without further ado, let's jump into this panel. We've got to my right Marla Blow, who's the CEO of FS Card and a partner at Fenway Summer. We have Ed Zimmerman, who's an attorney, investor, and works with many startups on both of those fronts with Lowenstein Sandler. We've got Christina Bechhold, who's a venture capitalist at Samsung Ventures, as well as a founder of Empire Angels, an angel group in town. And we've got, last but not least, Brendan Dickinson, partner at Canaan Ventures, coder and investor. So let's start with each panelist. Let's go down the line and just have you guys talk about what you do, what your background is, what maybe one or two interesting trends or developments you've seen in Fintech venture capital recently are. We'll start with Marla.
Thank you. It's a pleasure to be here, and I look forward to a robust discussion of what's going on in the venture capital space. So I'm Marla Blow. I'm a partner in a venture capital fund called Fenway Summer. And the role that I play there day to day primarily is I'm the CEO of Fenway Summer's credit card business. It's called FS Card. I started the company in January of 2014. We issue credit in the form of a MasterCard branded credit card product to deep subprime consumers who are otherwise fairly underserved by a significant portion of the mainstream financial arena. And I was a seed company and sort of incubated inside of Fenway Summer. So the relationship there has been very much integrated with Fenway Summer's growth and development overall. Fenway Summer is now a traditional venture capital fund, had a $40 million first fund, is in the process now and closing soon on its second fund, which should be somewhere in the neighborhood of $100 million. We are a seed stage and Series A investor. Typically focused on organizations that look at, obviously, the intersection of finance and technology. So we are exclusively focused on fintech at Fenway Summer, and all of our investments have been in that arena. It's worth noting that the general partner of Fenway Summer is minority and woman-owned, and about a third of the companies in our portfolio are minority and women-led. And that's been a particular focus for us as an organization and is an important component of how we think about the importance of being inclusive in this market and playing that role in the investment arena. We have made about 30 investments thus far, and we really focus on being value add in the sense that it's relevant background here, I suppose. I was also on the implementation team to help found the CFPB, which is the Consumer Financial Protection Bureau. So I had an unusual opportunity in 2011 to help start a brand new federal government agency from scratch. And prior to that, I'd actually never been in the public sector other than that experience. But what we bring at Fenway Summer to the table is that particular emphasis on the regulatory construct and the important complexity that the regulation plays in this space. And I think that is one of the things that makes fintech in particular both challenging and incredibly interesting. In terms of things that I think are of particular importance at this moment, I guess one of the things I spend a fair amount of my time thinking about is new ways to make decisions, right? And new ways to inform data-driven analysis, to be able to do so with fewer and fewer people than would have been required, say, when I was at my time at Capital One. Today, you can do some of the things that Capital One had entire divisions to do with 2 or 3 people and a couple of computers. So for me, I think the promise of data and what that portends is really one of the most interesting things. And although that's not necessarily a new trend, I am really intrigued with some of the ways that direction continues to grow and evolve. So, stop there.
Right. Ed?
Thanks. So I want to just start by noting that when Eric said that the fintech classes have full enrollment before they announce what's on the syllabus or maybe even who's teaching, it makes me wonder about the relatively robust enrollment in the venture capital class I teach at the business school here at Columbia. I thought it was like 11 years of good reviews, and apparently it's just a market trend. So I'm crestfallen, but we'll soldier on. So I'm Ed Zimmerman. I am a partner at Lowenstein Sandler, where I've worked for 25 years doing startups and growth companies and venture capital investment transactions and serving as outside general counsel to those companies and those funds. I started personally investing in 2006 and have made personal angel investments in more than 90 startups. And I think only one of them has gone through a full bankruptcy. I also personally invest in venture funds, so I'm an LP in about 30 different families of venture funds, mostly but not exclusively in the US. And I serve on the panel of experts at the Wall Street Journal with Christina, and have published 75 or so columns there and another couple of dozen in Forbes, where they let me also write about wine, which makes me very happy. So I've done a number of financial services related startup investments, and I think that there are some interesting characteristics about them. And because I think I am the longest tenured startup lawyer at a law firm in New York, I've seen what I would say is a disproportionate share of fintech venture-backed companies over time, just because New York has been more of a center for that than the Valley historically. Although now that it's hot, it's a little more spread out. I liked what you said about underserved or maybe even unbanked customer bases. I know that one of the issues we've had when we've seen companies attacking the underserved market is perhaps a lack of, I don't want to say empathy, but let's call it a lack of empathy from the venture community, where their initial reaction to those kinds of companies at least used to be unbanked, underbanked. I don't know anyone who's unbanked or underbanked. Why is that a big, exciting market? These are poor people. And so historically, that has been a little harder to fund. I've angel invested in at least one company that was specifically designed for unbanked and underbanked, because I very much believe in that market segment. So I also think that the data-driven analysis that you mentioned, not to totally water ski off of your insights, but largely, because there's no other way to water ski in New York. So sometimes those are not intuitive, and I've seen this play out repeatedly from Gerson Lerman Group years ago to 2 companies I was dealing with yesterday, where the company says, we believe that these insights are going to be purchased by hedge funds, and it turns out that they're purchased by companies and hedge funds don't give a damn. Or we believe that these insights are going to be really valuable to Fortune 500 companies, and it turns out that the companies don't give a damn and the hedge funds really want that. And so it does take a while to figure out who the real consumer for those insights will be. And then, one of the other trends that, I'm going to mention two trends. One is strategic investors play a much more significant role in fintech than they play in most of the other sectors that I cover as a lawyer, and most of the other sectors I invest in personally. And they come in earlier, they slow down the process, and I'm not saying that in a negative way or in a complaining way, just in terms of how long you think of the sales cycle or the deal cycle. They add complexity to the process, and often they're adding an analytical or intellectual framework that is not as venture-centric. And so that changes the dynamic of doing these deals, and there are ramifications of having them come in earlier. And then the final thing, since I do function as an angel investor, and I also represent companies where the founders care a lot about what happens at exit, I don't know how many of you are familiar with 1202 of the tax code, or qualified small business stock, which enables you to shelter up to $10 million or 10 times your cost of the gain, whichever's greater, per stockholder, of the gain at exit if you have a qualified small business and you've held the shares for 5 years or more. When the Clinton administration enacted that tax savings for entrepreneurs and startups and their investors, they wanted to incent certain types of businesses. Those don't include banks, they don't include broker-dealers. So while that applies broadly to almost all of the startups we represent in every other sector, it does not apply to all of the startups in fintech, and people at exit start really focusing on the stuff they should have been thinking about 5 years earlier. So you end up with this interesting set of tax outcomes for founders and for early investors, and it's something to think about, because fintech is actually a slightly different animal, not just because of the regulatory stuff, not just because of competing with the banks on what the intellectual property is, but also in so many other ways.
So I started my career in capital markets at Citigroup, and while I was there, co-founded Empire Angels, which is a member-led group of young professionals in New York investing in seed stage companies together. Unsurprisingly, a number of the people who can do angel investing as a young professional come from financial services, so that's quite a bit of our membership. And I think as a result, we tend to see most of the pre-seed and seed stage fintech companies in New York. In part because we've seen how backwards a lot of banking and financial services is, having been in the industry for a while, and so we can understand the solutions that they're providing. But also we tend to be the users of a lot of the products and services that we invest in. And it's a lot of our peers who are starting those kinds of companies. So actually, our first exit as a group and a fund was in the fintech space about 4 years ago. My day job is with Samsung Next Ventures. We're a $150 million fund focused exclusively on early stage software and services that have some relevance to Samsung's mobile, consumer electronics, or display businesses. So that's everything from digital health and automotive to microwaves and televisions. So it's a very broad investment mandate. I would say we're about 50% strategic and 50% financial. So we don't think that a financial failure can be a strategic win. And so we do, certainly measure ourselves against the sort of standard metrics of a standalone venture fund. But we also want to add value to our portfolio companies by facilitating collaborations with Samsung business units. And to do that, we need to make sure that companies are broadly in line with the areas of interest of Samsung. But generally speaking, I would say if it's not a bar or restaurant, we can probably take a look at it. Within the fintech space, the first investment that we made was in a company called LoopPay out of Cambridge, Massachusetts, which eventually was purchased by Samsung, one of only 3 companies in the portfolio that this has happened with, but became the basis of Samsung Pay, which is our digital wallet that was launched last year and now in 15 countries globally. I think digital wallet is an interesting space because but the adoption is very low across the various options that are out there. I think a large part of that is because the difference between pulling out your mobile device and pulling out your credit or debit card is not really that different. And in fact, it can be a bit of a pain to try to use some of the digital options. And so when we think about the opportunity to invest in the fintech space, we need to give our end users of our devices a reason to use that platform. And so it needs to have more functionality than just pure payments. And so we think about what are all the other pieces of the consumer financial experience, and what are the ways that we can use technology to make that simpler, easier, faster. So we look for opportunities that can scale broadly and serve large populations, saving them time or money. And then also, given that there are so many smartphones in the world, and often a smartphone is for many individuals their sort of first connection to the internet. What are the ways that we can leverage our device footprint to serve, as the other panelists were mentioning, those underserved and unbanked populations? Are there unique services that we can offer them that allow them to participate in the financial services industry through our devices? So those are sort of the two pieces that we look for from an investment perspective, and hopefully find ways to allow early stage companies to work with Samsung to grow their business.
Hi, I'm Brendan Dickinson. I'm a partner at Canaan Partners. Canaan is an early stage venture capital firm, currently investing our 10th fund of $675 million. We invest in both. We invest in both tech and life sciences. Tech makes up roughly 2/3 of our investments and runs the gamut from enterprise software, digital media, e-commerce, and fintech. Fintech is an area of focus for us. So we led Lending Club Series A in 2006. We've been quite active in fintech since then. Most of our investments center around consumer-facing marketplaces, broadly defined. So we have investments in lending, in various other asset classes, distribution of other asset classes, and insurance, amongst many others. And recently, insurance has been a real area of focus for us. I led 2 investments last summer in insurance, Ladder and in broker, and continue to think that there's a big opportunity there for the next generation of fintech companies to be built.
Great, thanks. Obviously, a lot of great experience across the different stages of life cycle on this panel. So let's try to highlight some of that with some questions, and we're going to open it up to the audience in about 10 minutes. Maybe starting at the end of your sort of funnel or your life cycle of venture, talk about the IPO market recently and what we've seen there, or other big exits, since a lot of companies are sort of avoiding IPO for longer periods of time. But what signals are you getting from some of those exits that maybe impact what you think's coming down the pipe, or what you're investing in?
Yeah, I mean, so we often don't work backwards from the IPO market in terms of what we invest in, right? We're looking at areas where we think that there is broad white space in terms of lack of technical tech innovation within a sector, and work from there. And then look for great teams in it. I mean, this probably sounds a little bit like VC cliche 101, but it also is true. So we don't focus on we don't work backwards from the exit, right? And so, for instance, when we led the investment in Lending Club, we viewed that there was an opportunity to rethink how capital is distributed, and saw an opportunity to reduce costs by moving a lot of that process online. Similarly, as we look at insurance, we look at a large market that has seen relatively to no tech innovation over the past 100 years. And so we view that as an opportunity to apply some of the advances we've seen in other areas of the market, as well as specifically in fintech, and bring that to bear. So that's not to totally dodge the question, but it's not how we think about not how we drive our investing.
Mm-hmm. Anybody else want to touch that?
I'm happy to, but why don't you go?
I led before. I got to ski off of you this time. So.
Damn it. Marla wins. Okay. So I want to parse something that Brendan just said, which is that we don't work backwards. And I feel like that's true from an investment thesis perspective, but probably not from a valuation math perspective. So I also started this thing with some friends called Venture Crush, and we host these events in New York and San Francisco. We just, a week and a half ago, had our first Venture Crush Paris event, and I published something in Forbes on it where we had a conversation between VCs and the limited partners that fund the venture funds themselves, and we talked about backwards math. And when you look at the exit market, you start by assuming that it will be not dramatically different 5 years later or 10 years later when you actually exit, and you have to figure out whatever the white space into which you are investing from an investment thesis perspective will be. There has to be some sort of math that makes sense, which is why venture funds, for instance, say, you know, this market may never get beyond $50 million. See you later. This is not a venture backable company. If you're going to go into, you know, space where you have no idea what the market is going to be, that could still be the sort of Big Bang Theory type opportunity. But there has to be some sort of math. So one of the things that we look at is we layered unicorn birth rate, and unicorns are companies that attain $1 billion valuation or greater, unicorn birth rate over unicorn exit rate. And unfortunately, we were, about a year and a half ago, birthing about 5 times, 4 times as many unicorns as we were exiting. That is not a sustainable pace. And when you look at how those two things overlay, you see that the jaws kind of close. Unfortunately, it's not because the exits have increased dramatically. It's because the birth rate has gone down. And so from a trend perspective, we're seeing the exit market is somewhat stable. A lot of exits fail to defy gravity. So more than 75% of venture-backed exits are under $200 million in this country. In Europe, that number would be more like 30 million euros, maybe 40 million euros. It's a very different market, which is why it is imperative for European venture-backed companies to come to the States, less imperative for American venture-backed companies to head overseas, although it's important in fintech. And we are seeing an uptick in the IPO market. I suspect that, so we're ahead of pace, and they're trading a little bit better. This year we're ahead of last year's pace. So those are just a couple of currents that we're looking at, and we are seeing a few more flat rounds and down rounds this year. And when that happens, you always worry, gosh, is it just my portfolio, or is it just the companies that we represent as a law firm? But we feel we do more than 500 venture deals a year as a law firm. So we feel pretty confident that the Q2 numbers that CB Insights and others will publish in July are going to show that there are a few more down rounds, a few more bridge rounds as well.
Yeah, I think the thing I'd add about the IPO market that is an important indicator and an important proof of concept role that plays, right? And it's not because necessarily, although there is the math and valuation that's important, but it is also a useful tool to be able to demonstrate that businesses like fintech, businesses that are getting started now, do actually function and work in a public market arena. And so for us, an example of that is a company called Elevate, which is a sort of credit provider with a bank partner. There are very few of those organizations that have actually been in existence for any extensive period of time, and they're the only ones that have gone public in quite a while, or perhaps ever. And so that was a really important proof point for a set of organizations that have gotten started, sought out bank partners, gone into lending businesses, or in other ways engaged in consumer lending, and have now seen some path and some sort of light of day. And now there's sort of a public market stamp on that entity and those kinds of entities, in the same way that categories of technology organizations benefit as software as a service, for example, as a class of companies. Useful to see the numbers of IPOs in that space. Similarly, need to see that in fintech. Another example I'd use, this one is not an IPO, but there's an organization called Continental Finance, which has issued a private securitization. But being able to access the capital markets in that way and being able to execute a new securitization in the market is a big step, or there hasn't been a new securitization in the credit card space since the financial crisis. And that important proof point, again, helps create a glide path for entities that are getting started today that are just setting out down this path of trying to establish themselves and have something to be able to point to when they go to institutional investors, potential partners, and talk about where this can go. Having those kinds of proof points really matter, and I think it makes that story a lot easier to tell, and I think it makes the investor on the other side feel a lot more comfortable that that new ground is not necessarily going to have to be broken at every single stage of this life cycle.
So we heard a little bit about strategics and what Ed was talking about, and some of the bank partners, and what Marla was talking about. So, how are the established companies in this business responding? I mean, the Economist last year called Fintech startups a small ant chewing at the ankles of big banks. Are there, is that changing? Are they co-opting? Are they partnering? Is it just ultimately more profit? The more these innovations come across, and how does that change your view when you're interacting with either strategics as potential co-investors or even competition or partners?
So I would say a couple things. First, I think strategics or the incumbent banks are trying to figure out what to do. A fun tidbit is that I know that for two of the largest top 5 banks, a top strategic digital initiative is building their own robo-advisor this year, which is sort of funny when you think of the fact that that's something that's been out there for quite a bit of time, and just now that is the top strategic initiative. But it's also a defensive move, right? You don't want to see people's money going to Betterment or Vanguard, but if it's at Citi, it should stay at Citi. So that's one piece. The other piece is, right, you actually haven't, at least as I think about lending, right, you haven't seen a lot of acquisition. And that's largely because these things have been financed at such high valuations. It is hard for a bank to buy a company at a valuation that the existing investors are going to find palatable, and without having to take a shockingly high goodwill charge. So that's been a real conundrum. You haven't actually seen as much M&A as you might think you would. Now, I'll make one other point, and then I'll turn it over to the rest of the panel. In the insurance market, it's been quite interesting. So insurance has the benefit of having watched the innovation in personal finance management and lending over the past decade, and trying to learn from it. And so the various carriers and Res are incredibly concerned about what is going to happen next, where they're going to sell their next premium dollar, because they know that 30-year-olds don't want to buy the way people buy insurance right now. People don't want to talk face-to-face and be upsold. And so they are all actively engaging very heavily with the insurance startup ecosystem, either partnering with to launch or trying to invest directly in. And it's been a very interesting dynamic to watch, and I think it's driven a lot by what we saw happen in lending and in personal financial management.
I mean, I think certainly every bank, and certainly a lot of anyone in the payment space seems to have a group of people saying they're doing venture investing. They probably have an innovation lab somewhere with a cool office and a couple of startups in it. They may be dedicating significant or less significant resources to those initiatives. I think some of them do it very well, and I think for some of them it's a little more window dressing. But I think the big challenge is more of an internal one for them, which is sort of winning the hearts and minds of the individuals and the businesses who they actually need to work with in order for any of the technologies that they're partnering with or investing in or incubating to actually be adopted. And I think when you talk to the vast majority of people in those businesses, their businesses they feel are doing fine. They don't feel that they're being disrupted by the little guys who are building a nice little business for themselves. But if you're JP Morgan or Citigroup, that may not be relevant for you. That's just not gonna matter to your P&L for the year. And so I think that's the big struggle when I talk to people who are doing investing for these larger banks is how do you get that influence at a high enough level that it trickles down into the individuals who manage those businesses and find ways for those companies to come in and help them to get ahead of the curve. So I think if you were an entrepreneur thinking about working with those partners, making sure that you understand how do they really work with the companies that they are investing in or partnering with. Who are the decision makers? What are some case studies of success stories that they've seen internally? I think taking money from a strategic has no value for you if they're not going to be able to find a way for you to work with the mothership. So I encourage entrepreneurs to always do their diligence on strategics, and I think that's especially important in the fintech space.
Maybe shifting gears a little bit, let's talk about earlier stages of company formation, because you've all done some angel work and some pre-seed or some seed investing. What are you looking for in markets where sometimes the math is fuzzy, you don't know how big it's going to get, you don't have a lot of traction to base on? What are some of the positive investment decisions you've made on really early fintech teams, and what did they bring to the table that was outstanding that made you go that way?
Yeah, I can talk about a paradigm and then I can give an example. One of the ways that we think about making early stage decisions when there really is no proof of concept, it's before there's in some cases even a prototype of a product or service. And one of the ways we think about this and think about the decision that you're really making about a person or a potential team. And one of the ways we think about that is around proximity to the problem. Right? Proximity came up in some earlier comments from some of the panelists as well on people that are not close to the experience of some of the people we might be talking about, right? Who themselves have never been underserved or don't know anybody who's underserved or unbanked. And it's very difficult if you are not proximate to the problem to be able to come up with a good working solution, right? To be able to sympathize, empathize, think through the needs of the customer you're trying to serve in a way that is likely to lead to an effective solution, right? Or an effective approach to serving that customer base. And I think it's one of the drivers for things like, here's a new app that helps you figure out how to do your laundry, right? Or whatever, because those are things that everyone can relate to. But when you get into places like an underserved population or trying to get somebody a particular kind of service that many people in this country have never had to really rethink because they get to take it for granted. It's a nice position to be in. When you're there, then we think through how well does this person actually identify, and how likely is this person that's pitching this idea or thinking about building this business, how likely are they themselves to understand the needs of the person they're trying to serve? And that seems to correlate very nicely with outcomes, and it's one of the drivers that we really value and look for in the entrepreneurs that we invest in at the seed stage.
Can I actually jump in on the underserved comment? Because I think I actually totally agree that I think that there's not enough people close to the problem that have the experience. But I think also, and this is just a broader comment around fintech, but it relates. One of the challenges with funding that from the venture perspective is, yes, not being proximate to it, but also too, banking businesses make money lending money, right? They don't make money from holding your money. They don't really make that much money on interchange. And so it's very, very hard, and you haven't seen anything get big building a money management side of the business. All of the large players have gotten big off of lending, right? And if you're going to do the work to acquire a loan, it's much more palatable or attractive to acquire a $10,000 loan than a $100 loan, because what you make off that is dramatically different. And that's it's a challenge. I wish that I would love to see, and I've looked at a couple companies and almost invested in one of them, and would love to find a business model that works better, but it's just hard because it's an equal amount of work, but for a much lower dollar value.
Yeah, I think that's fair. I hope the one you almost invested in was FS Card, because I think we hit up Canaan Partners for money recently and got turned down. But I think it is one of the real challenges. I think that's right. And I think it's worth thinking about. Both sides of the equation have to be really careful, and And both sides, by that I mean, if you're a seed stage company and you're thinking about partnering, seeking capital or whatever from a large financial institution in particular, those institutions are, I think, as Ed and Christina both suggested, tend to move slowly, right? And you can run out of runway, you can hit a wall before those organizations could even make a decision. And that, before they could even get to a yes, right? They may want to get to yes, but you have to survive to be able to get to their yes, right? And they have to approach that carefully. The banks and the big institutions have to approach this carefully because when banks execute on something or offer a product, it has to work every time for everyone. It is not I have an app, it's on this kind of phone, here's the 5,000 people that have downloaded it, and it works perfectly for those 5,000 people. That is effectively a good way to start an interesting small opportunity, but a big bank cannot function that way. And so they can't, in many respects, be at the leading edge of trying out something that works for a portion of their population. It has to work every time for everyone. It has to be consistent with the regulatory apparatus, or it risks a giant enterprise that is otherwise functioning quite well. So that caution and that approach, I'm thinking about how do you manage loans, how do you manage large ones, small ones, et cetera, makes it something that has some tension between what it does at the startup level versus what it means for big entities.
Can I just add one thing? So I want to draw a distinction between large strategic investors, where the people who are making the investment into the startup are not kind of indigenous people in the startup community and have other responsibilities in addition to investing in startups, as opposed to an organization that has a dedicated fund with venture professionals who come from and live in that community. And I think you and your colleagues are a good example. There are others as well, that you function more like a venture fund, and the rhythm of how you operate is more like a venture fund. We're in a couple of deals with you, and I'm negotiating with one of your colleagues this coming week on something. And I know that there's a difference. The banks are different, and that's where I see it. And then just on the question of seed and what you look for, to me, when I invest in a company personally at super early primordial soup stage, it's all about the founders. And there's an investment that I made where I thought the idea was a bad idea. It wasn't fintech. It was lead generation to help people find a local gym to work out in. And I didn't like the idea, but I had helped the founder, or I had helped acquire the first company that founder had started. The company was called Gym Ticket. Then it changed its name to Alpha, and then it changed its name to Yext. And I was one of the 2 original angels in Yext, which IPO'd 2 months ago, or a month and a half ago. And the business that they pitched at the time was gone years ago. And it doesn't matter, because at that stage, it's really hard, and you have a smart enough team that you're excited enough about, they'll figure it out. That is not the case at B Round.
Congrats. So we're going to open up to Q&A from the audience, and the way we're going to do that is we're going to have 2 or 3 questions come in at one time, and then we're going to kind of package those up for the panel. So when we start to my left, right here.
Thank you very much. My name is Maria Lopez, and I am a student of Columbia. The first question that I have is, based off what I have seen, there is a gender gap in startups led by women compared to men. And my question here is for Marla, and I have another question for Christina. The first one is, for Marla, what are the key strategies that women can use to be successful new entrepreneurs? And the question for Christina is, are you seeing more young professional entrepreneurs, women? And what is the ratio you are seeing in younger generation of entrepreneurs of women compared to men? Thank you.
Great. Let's take this one.
Hey, my name is Bobby Corona. I'm running a startup, blockchain and smart contract startup, and my question from the VC community is, what is your take on ICOs? So right now, we did touched IPOs, but what about ICO, and how is there, is it an altering the traditional VC model? Is it a threat? Is it an opportunity, or is it just a recalibration? So it'd be good to have that perspective from the VC community.
One more question, then we'll go to the panel. Gentleman in front right here.
Hi, my name is Brian Chen. We launched a startup last year. It's called Rosca Finance. So this is a question in general for the panel. There's been a lot of mention of the underbanked here. Is there a bifurcation between the underbanked and underserved and the poor? Do you invest differently for those two different parties?
Okay. All right. Let's take those. Let's take those in order. So why don't we start with the gender gap in really in entrepreneurship, but I think we're looking at this from an angle of venture capital investing. So what are you seeing, and maybe what advice do you have on that particular issue?
Yeah, no, I think it's a great question. I think it's a hard one. So you start with the softball right there out of the gate. Huh? I think, importantly, having something that you firmly believe in and are willing to invest in heart and soul is one of the most important decision vectors, I guess, for an entrepreneur and for women, because it is hard. And because running a startup and trying to go through that early struggle and getting a company off the ground from day one is a roller coaster ride, like on an hourly basis, right? And being willing to go through that for anyone is incredibly challenging. One of the most important decisions I think if I could go back in time, what I would do differently is to choose who I went to seek capital from very, very carefully and very, very strategically. I went out and pitched FS Card to everyone under the sun, everyone I knew. I have the good fortune of being in a number of networks and had access to a lot of people, so I could go and talk about this to people for whom there was never a chance that they were going to invest in FS Card. And the energy and time that took out of me to go chasing the wrong people and the wrong pockets of capital was really costly, right? And I would advise, I guess, to think about if you are pitching something that is likely to resonate with the audience that you're pitching to, your likelihood of success goes up. I think potentially the unpopular outcome of that is oftentimes what's being pitched is being pitched to men. It is often being pitched to white men, almost exclusively. And if you are pitching something that white men can't relate to, it's going to be harder, right? So think through where there might be opportunities to pitch to people who are more likely to be able to relate to what you're doing. It means you're going to have to do a lot more sifting and looking under a lot more hidden spots, but it's more likely to pay off in my view. That's my guess.
Anybody else want to add to that?
Oh, and to your question on sort of trends in, I guess, the percentage or of women versus male founders, I think it's important to think about in the context of venture backable businesses. So companies that can scale, rapidly and serve very large markets. I see many more men starting those kinds of businesses than I do women. I meet with any female entrepreneur that asks to meet with me. I'm more than happy to give advice, and I will take any meeting if anyone ever emails or tweets at me. I'm happy to do it. But I will say the vast majority of the businesses that I see women starting are in sectors that tend to focus on women, and those things that I see in New York a lot are beauty companies, fashion companies, and things like that, which often are not necessarily venture backable. They're companies that can raise some amount of outside capital. Maybe they become nice cash flow or dividend businesses for those investors. That's different than the big, huge, audacious companies that VCs want to back. And so I think part of it is just being very realistic about the kind of company you want to start and what kind of money is appropriate for that business. There is nothing wrong with starting a great cash flow business, keeping all of the equity for yourself and making lots of money. There's nothing wrong with that path. But it's a very different path than what venture capitalists want to back because of the economics of how that works. So I would say, I want to see more women starting those kinds of companies. But I've looked at the numbers. I have a TED talk on it. Women start fewer of those kinds of companies, and I think we need to empower women to feel that they can go after those big markets. They certainly have the skills, and the companies that they start tend to do better. The numbers show it. So. I think there's a lot of work to be done, but I'm hopeful.
Go ahead.
I just wanted to jump in to Marla's comment. I think it also is very incumbent on my industry, the venture capital industry, to do a better job of creating diverse firms that are not filled with white men like myself. I feel this is where I'm going to give a little plug to my firm. But I feel I'm very proud of the partnership that we've built. We're roughly 30% of our check writers. So that's people who can actually take a board seat and write a check are female. That's obviously not 50-50, but I think it's also a huge step in the right direction compared to the rest of the industry. But I think it is really incumbent upon the VCs to do some work themselves.
That is about 4 times the industry norm. That is great. I feel pretty strongly about this issue and published a pledge against gender bias in the Wall Street Journal about 2.5 years ago, which I've been following. And I think one of the things I've seen with my students is that at Columbia is the boys apply for jobs for which they are unqualified and think nothing of it.
Absolutely.
And the women often say, I'm not going to apply for these jobs because I am not qualified. And every year I tell them, the boys in class don't feel that way. Let the employer decide. And we need to realize that when you are recruiting and you decide that it's time to diversify your startup or your venture fund, putting an ad in that says we're looking for diverse candidates is inadequate and insufficient. Your recruiting is the totality of your conduct and statements over the last several years, over a number of years. And so you need to think about the events you host. You need to think about the way that you conduct yourself in public. You need to think about the type of social media where you're publishing. You need to think about the word choice in what you're describing and what you look for, the pictures that you and your team post on social media. And if you don't diversify within the first 10 hires, how are you going to show a face to the world that says this is a welcoming place? It's something I feel really strongly about, and I'm happy to talk to people more about that offline.
We got one more question. Thanks. We'll do Bobby's question. I was wondering how long it would take for someone to say the B word, blockchain. 43 minutes is not bad. So, I mean, the question is really about: is this new paradigm for financial services and ledgers something that is going to distort investing or the way the sector works, and what kind of time frame? And then specifically, these coin offerings that have been popping up lately. What's your perception on that?
So I'll start, and I think it's probably worth having Ed talk about the consensus algorithms. Sorry, that's a panel joke. But it probably is worth having you talk about the legal side of it. At the risk of being a totally blah panel member, I think it's a little too early to really say. I think if it's if it's relevant to your core business, then it makes sense. I also would ask, would you advise people to invest a significant sum of their net worth into a company where it's an early stage venture that they have no control over? I think is another relevant question to ask. That said, I at the risk of being totally lame up here, it's too early. I don't think we could say it's the next wave. I don't know if it'll distort the market or not. Legally?
The floor is yours.
All right, you guys are taking a courageous wait-and-see approach. I love it. So for those who noticed that I threw something at him, just note that it hit. That's all I'm saying. So look, people are spending an enormous amount of time discussing blockchain and discussing how important the platform is and the application for things like land recording in non-Western countries where there's no effective title office. And I think it's really, really interesting. I think that there are people who will make a lot of money. I'm less concerned. I probably should be more concerned than you are. I'm maybe a little less concerned about the regulatory framework than I am in, say, cannabis investing. And we see a ton of cannabis deals. I've passed on every cannabis deal. I'm
Pass to the left or pass to the right?
For those old enough, I've passed the Dutchie Parmy left-hand side.
I'm on the left.
Revealing your age. Because that's something where right now it is unlawful from a number of perspectives. I also worry about the competitors and that, they might kill you. And I don't feel that way about blockchain. And it's also, no, but seriously, it's also, as an angel investor, I can be economically irrational, and I like that. I'm not a fiduciary. And I know that there are people who are going to make a lot of money on cannabis. Cannabis is not something that is particularly important to me. I don't care deeply about cannabis. The blockchain is intellectually pretty fascinating to me. And if I invested solely in things I cared deeply about, I'd be losing all my money on music and wine startups right now. So fortunately, there's some rationality. So I do think it's interesting. I do think that Brendan's comments from, when you have, for those of you who don't know this, the larger the Roman numeral after the fund name, the more prestigious and experienced and sophisticated the fund is as a general rule of thumb, right? So Canaan has raised 10 funds. They've been around for a long time. They're international. They're bi-coastal. That's a great fund. And I think you've just heard a viewpoint expressed, and I think you're going to see that in the marketplace. And as an angel, my biggest risk are the next wave of investors going to back this company. My biggest risk is capital risk. Everything else gets de-risked in subsequent rounds. So if I'm worried about capital risk because he's really smart and spends a lot of time on fintech and is taking a wait-and-see approach on blockchain, that's a message I already know, and I'm concerned about it.
On that note, we're out of time, but let's thank our panel. Thanks for a great discussion. And thank all of you.